Riccardo, thanks very much for joining us. It would be good to get a sense, I suppose, from what the Oxford economics view is, particularly on the macro side, looking at Europe and interest rates.
We see some further slowdown in 2023 happening due to a variety of factors. We have monetary policy, which is tightening. Dig deeper a bit into that in a second. We have the dent of high inflation into real incomes of a household. So we have consumption, which will be less of a support to economic growth this year. And we'll also have dying out catch-up effect from COVID times. So due to the combinations of the factors, we see a sluggish 2023, especially due to two quarters that are particularly weak, Q1 and Q2 at the beginning of the year. And then we'll see a gradual recovery. Why this gradual recovery? Because of all of these channels, and in particular the monetary policy channel. Because we are seeing sticking inflation and we are seeing positive growth surprises. So this will lead the European Central Bank to hike rates in March. And of course, that will spill over to government bond yields, and from that also into interest rates in the real economy. So both interest rates are faced by households and by firms. So of course, this will take a toll on growth, especially by investment.
And do you see that then an improving picture gradually over 2023 and particularly going into 2024, Riccardo?
Yes, that's exactly the case. So while we have all of these factors combined will take a toll on 2023 growth, we'll see a gradual recovery towards the end of the year, and we should see a healthier 2024. This is because our economies have already adapted to this new situation of high energy prices, reduced gas supply. Of course, there's a lot of uncertainty around all of this because it all depends on geopolitical events, so they are very difficult to predict. But at the same time, we have an industrial sector that has already borne the most of the brunt of its impact. So I would say that 2024 is probably a better year for industrial production in general, because of course we have already borne the cost of adapting to this new setting, but also because the negative impact of tightening monetary policy will gradually die out over 2024, because inflationary pressures will fade. So the European Central Bank will likely pause its rate hiking cycle. So this will probably entail a lower impact on growth in the economy.
And we've obviously seen quite a big impact on the real estate sector, especially from rising interest rates and financing costs. Do you expect that picture to gradually improve? Particularly if we're looking there, you mentioned industrial growth, particularly if we're looking at sectors, which have been booming previously, but are repricing, like logistics, for example.
Yes, so we are seeing already interest rates for both mortgages and companies in general, so for company lending in general, going up, because of course you tend to have a spread which is applied onto government bond yields, which will at the same time react to what policy rates are. So of course we think that interest rates will go up in the short term. This will diminish with time, especially as policy rates stay constant and then start going down over the year of 2024. So of course there'll be a lag, because rates tend to relax with a lag. But going forward, we do expect a normalization of interest rates also in the real economy.
Great. Really interesting to catch up. Thanks for joining us, Riccardo.
It's been a pleasure. Thank you.